There's a lot of noise in the news lately about commercial real estate, and mainstream media is making it seem like the entire industry is on the brink of collapse and every property owner is going to get hurt. But the reality is that commercial real estate is made up of a lot of different product types and geographic markets, each of which can perform very differently at the same time, which is exactly what we're seeing today across the United States. So to help you make sense of everything you might be hearing about commercial real estate right now, in this video we'll talk through the current state of the four main commercial real estate product types, including multifamily, industrial, retail, and office, and what the latest research is telling us about each. So let's start off with one of the most popular product types in commercial real estate, multifamily, which is seeing a significant number of challenges that are impacting valuations. According to Avis & Young, average multifamily cap rates in the US increased from just 4% in the first quarter of 2022 to 5.2% in the fourth quarter of 2023, representing a 23% decrease in multifamily pricing, all else being equal. And along with an increase in cap rates, multifamily inventory across the US has risen by almost 15% since the start of 2020, and over 530,000 units are expected to be delivered in 2024, according to Yardi Matrix. Multifamily vacancy rates sat at just 2.5% nationally in the second quarter of 2022, but as a result of all this new supply, this number jumped up to 5.8% in the fourth quarter of 2023, which was the highest national vacancy rate this sector has seen since 2014. Year-over-year rent growth also dropped to just 0.2% in the fourth quarter of last year, which was significantly below rent growth figures we saw from 2011 to 2019, and according to CBRE, 2023 multifamily investment volume dropped to the lowest level we've seen in almost 10 years. In 2021 and 2022, cities like Austin, Phoenix, Las Vegas, and Orlando saw some of the biggest rent growth figures across the entire country, but today these cities are seeing some of the biggest pullbacks in market rents, with year-over-year rent decreases coming in at 3.1% in Las Vegas, 4% in Orlando, 4.4% in Phoenix, and 5.8% in Austin. And at the same time, operating expense loads have increased substantially on many multifamily assets, with owners seeing an average year-over-year operating expense increase of 7.7% in 2023, led by a 33% increase in property insurance costs alone. What seems to be saving multifamily right now is that the cost to own is still significantly higher than the cost to rent, with this spread coming in at over $1,000 a month according to Newmark research, and with interest rates expected to stay relatively high through at least the middle of this year, it's very unlikely that this is going to change anytime soon. Now, from here, let's move on to the industrial asset class next, which alongside multifamily has been one of the most sought after product types for investors within commercial real estate. According to Colliers research, the US saw a record 607 million square feet of new industrial supply delivered in 2023, which, similar to multifamily, caused national industrial vacancy rates to spike by almost 200 basis points up to 5.5%, which was the highest figure on record since 2016. And even though that 5.5% figure represented the national average, according to JLL, markets like Austin, Phoenix, Dallas-Fort Worth, and Orlando, which has seen some of the biggest supply growth across the entire country over the last few years, are now seeing availability rates for industrial product of over 10% at the same time that industrial transaction volume dropped to the lowest levels we've seen since 2017. And after record high leasing activity in 2021, industrial leasing has also been on a downward trend over the last few years, falling from over 1 billion square feet in 2021 to just 790 million square feet in 2023. And according to CBRE, average asking rent growth has also fallen by more than half since the fourth quarter of 2022. But with that said, double-digit rent growth isn't sustainable indefinitely, and with this still coming in at a healthy 6% in Q4 of 2023, industrial rent growth is still well above its averages from 2013 to 2020. And even with so much supply coming into the market today, construction starts have also dropped significantly by 59% since the third quarter of 2022, which is projected to result in a material drop in new deliveries throughout the rest of 2024 and into 2025. According to CBRE, the December Consumer Sentiment Index also increased by almost 40% from the all-time low we saw in June of 2022, and with millennials, which represent the largest US generation and one of the biggest cohorts of online shoppers, starting to move into their peak spending years, demand is very likely to continue to outpace supply within the industrial sector. Now, unlike multifamily and industrial, retail is seeing some of the strongest supply and demand dynamics throughout the entire industry, and retail performance in 2023 reflected this for investors. According to Cushman & Wakefield, national shopping center vacancy in Q4 of 2023 came in at just 5.3%, representing the lowest rate on record since 2007. And according to CBRE, the availability rate for retail as a whole dropped to just 4.7% nationally at the end of Q4. In 2023, we also saw 769 net retail store openings, which marked the first 2-year stretch of more store openings than store closings in the US since 2013 to 2014. And according to CBRE, an all-time quarterly low of just 5.3 million square feet of retail space was delivered in the fourth quarter of 2023, and total completions for the year came in at just 27 million square feet, also representing a 10-year low. And because of increasing tenant demand and record low new supply, asking rents increased by 2.4% in 2023, and these have grown consistently over the last decade despite the constant talk of e-commerce inevitably hurting brick and mortar sales. Even regional malls saw positive net absorption in the fourth quarter of 2023, with vacancy dropping to just 8.5% in this sector, and retail sales overall also jumped by 5.6% year over year in Q4 of 2023. Right now, retail has the healthiest supply and demand dynamics of any major commercial real estate product type, and with construction costs and interest rates that are making development projects really tough to pencil right now, it's hard to see this changing much throughout the rest of the year. Now, last but not least, we need to talk about the office sector, and in the vast majority of cases, things are not looking good. According to Cushman & Wakefield, tenant demand for office space has now been negative for 8 straight quarters, and the national office vacancy rate increased to an all-time high of 19.7% in Q4 of 2023. Office utilization rates are still nowhere close to where they were 4 years ago, sitting at an average of just under 49% of their pre-2020 levels as of January of 2024, and leasing activity is still significantly below 2010 to 2019 levels for all types of office buildings in most US markets. And according to Newmark, as of December of 2023, employees spent about 30% of the work week working from home, which is down from a high of almost 62% back in 2020, but still almost 5 times higher than this figure was just 5 years ago. According to CBRE, Seattle, Los Angeles, Dallas-Fort Worth, and San Francisco all saw over 1 million square feet of negative net absorption in the fourth quarter of 2023, and the spread between asking rents and taking rents nationally is also at the highest levels we've ever seen. Right now, the office sector is really struggling, and while the total office product under construction has fallen from almost 110 million square feet in Q4 of 2019 to less than 60 million square feet in Q4 of 2023, there's still going to need to be a significant increase in demand to provide any sort of relief for office property owners. So I hope this is helpful if you're trying to decide which part of the industry you want to work in or where you might want to invest your own capital in the market. And if you want to learn more about real estate financial modeling and how investors both analyze and value commercial properties, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the current state of the market, make sure to hit the like button and let me know. And let me know in the comments which product type you're most bullish on in 2024 and why that's the case. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.